Welcome to the Intermarket Analysis video update. This is a weekly video where I go through a number of different areas where we look outside of the S&P just to see if we can get some insight as to what's happening with stocks. And this was a pretty crazy week during a pretty crazy time, and there have been some shifts. So I'll try to point those out as we go through things. This is being prepared for Monday, April 14th. The areas that I'll cover first are the valuation of the S&P itself. We look backwards at historical earnings reports that have already come out, and then we look forward to see what does the market think as far as earnings. Go through growth versus value, and we're seeing some not real shifts yet, but potential shifts. We want growth to outperform value when we're going up, and we're seeing value outperforming growth, and that's more defensive, and that's what the market often does before it's getting ready to decline. Now, we could come back from this, but we are seeing a breakdown overall. Inflation doesn't seem to really be a problem right now, either based on the charts that we look at when we look at commodities or inflation expectations or the economic reports that have been coming out, but there's a fear that that could really pick up going forward. And then we look at some other markets that we usually don't pay that much of attention to during the week, just to see how they're doing. Then I go through the 11 sectors that make up the S&P. Now, some of these sectors are growth related, some of them are value related, and some of them go up and down as the economy goes up and down. Then we look at some other indexes and see how are things shaping up in other areas of the market. We look at correlations between mainly stocks and either interest rates or other markets. We look at some very long-term trends just to see how that's coming up for right now. And then at the very end, I have a positive list and a negative list. Okay, first we look at valuation. We've been coming down. Now this looks backwards. This uses a PE ratio of 10, 15, and 20. When we're above 20, the market is considered to be expensive. And even though we've been coming down, we're still well above this red dashed line. Now we would have to come down to 4,200 just to be fairly priced when you look back at historical earnings. So we're still considered to be expensive, even though this red line has been coming down. This also shows that same thing, but it goes back to 1980 and then different events and what the valuations were. And you can see over time, the market spends years at a time being overvalued. So it's something that we don't use to make decisions. When we start going down, it's like I see more charts about that. There's more folks that talk about that. But when we're going up, it's like, okay, we're overvalued, but we're still going up. And the market doesn't seem to pay attention to that as much. We also use a variation, the Shiller PE ratio. This smooths earnings out over a 10-year period of time. And even though it's dropping, it's still quite a bit higher than the median and the mean. We're coming in at 33. The median and the mean are anywhere between 16 and 17. And you can see just by looking at the chart that we are also overvalued even though we're coming down. The market looks forward, and these are the forward-looking PE ratios. When you look at the purple line here, this is the Mega Cap 8 or the Magnificent 7 or whatever you want to call them. And even though they've been coming down, we're still above that 20 level. We use that same scale for this chart. They're coming in at 23.7. Now, what is coming down are the forward PE ratios for the S&P 500. That finally is coming in under 20 after it had been above 20 up into the plus 22 range for a while, and it's currently at 19.3. The small caps and the mid caps, which are in downtrends now, they're actually falling under that fairly valued price or fairly valued level here at 13.7 for the mid caps and right at 13 for the small caps. Then this is another chart just showing the forward-looking PE ratio where it has it dropping down to 18. This was a couple days ago, and we did have a 5% increase this past week, so it could be bumping that multiple number back up. And these are the 10-year. This is a variation of the Shiller PE ratio, looking at developed markets and emerging markets, and then U.S. markets here, which are on black. We've been coming down, but it's still giving us a very high reading compared to either emerging markets in red or the developed markets in blue. All right, now growth versus value. We are taking a bit of a hit here. but we haven't switched over to a downtrend at least yet. And we are going down. We're below the 200-day moving average. The red line, which is the 50-period moving average, is coming down, but it hasn't crossed over negative yet. Now, value's also been taken ahead. Both areas of the market have been really hammered lately. We're also underneath the 200-day moving average here, but this uptrend is a little more established. Now we look at ratios between growth versus value, and this is where we get the insight. When growth is outperforming, that's more positive. When value is outperforming, that's more negative. And we're kind of going along sideways here. We're hanging on to an uptrend with this growth to value ratio here, but we're dealing with the 200-day moving average. And we've been seeing a bounce back up of value in relation to growth. Then I look at this in a number of different ways. This is a pure growth index versus a pure value index, where we're just about ready to see a death cross here with this ratio. That would be more negative. And we look at a value to growth ETF here, where we're just about ready to see a golden cross, meaning the value is outperforming growth. Here's the other look at the ETF showing how growth is just about getting ready to underperform value. It's getting close. And the indexes showing how growth has still been outperforming. We have a little bit more ways to go for this to cross over, but it has been weaker. And then this shows how value's been underperforming, but really starting to come back with a little further to go until a golden cross is generated there. I show this in the daily video. We are seeing some general overall weakness when we look at the growth to value ETFs. This is that same thing, but in inverse of that, we're seeing how the value has been showing some strength in reference to growth. And we look at the mid cap growth here, still above the 200-day moving average. That's showing some improvement, but it's underneath this 50-day moving average, and at best has just been going sideways. Small cap growth to value actually saw a little bit of a surge here, but it still hasn't been performing all that well as the index has really been under pressure. This is the one that we're more concerned about. This is S&P growth to value, and we're just about getting ready to see a death cross with this ratio, and that would be more negative for the large caps. Inflation still looks like it's fairly under control here. The CRB index, this is a monthly chart. These are commodities. It's coming down to its moving average, which is a 12-period moving average since this is a monthly chart. So it's been coming down a little bit there. We have been turning back up a little bit, but we're still below a declining moving average when we look at the inflation versus deflation ratio. And let's see, with commodities, this is what folks have been really pointing to. This is still in a daily uptrend, but it really fell back recently. The Baltic Dry Index, it had been really going up. Now it's starting to come back down, and it's still in a longer-term downtrend, not really suggesting any inflation here. Inflation expectations, really since the beginning of 2025, they've been coming down as far as this ETF is concerned. And then we look at a ratio between the inflation's expectations, which I just showed, and then tips, which this is what people get into when they're worried about interest rates and inflation going up. And we've been seeing interest rates going up. So this ratio is also going up here, but it's still pretty much just in that sideways range. Some other markets, we have aluminum, which is in a downtrend. That's not inflationary. Corn is starting to go up into an uptrend. And that is a little bit inflationary, but it's not really skyrocketing. We have wheat that continues to be in a downtrend. Fertilizer's been going up a little bit lately, but not really breaking out of the range that it's been in. Lumber is in an uptrend, but really pulling back, falling under its 50-day moving average. Oil is in a downtrend. And this is something that we all feel more when we go get gas for our vehicles, where this has actually been declining in spite of all the geopolitical instability and all the crazy things going on. But there's been a real effort to bring oil production back to the U.S. We look at a gold to oil ratio. Gold has been going up as oil's been going down, so this ratio is going up. And then we look at the 10-year yield, which tends to go more in correlation with oil, but now they're they're decoupling from each other. We've been seeing oil actually with this going up as the 10-year yield has actually been coming down a little bit here. And we're actually seeing that them going a little bit in the opposite direction on a correlation basis. Heating oil is in a downtrend. That's helpful. Gas just starting to show an uptrend, but then it really fell back under $2. Natural gas is in an uptrend. And then we look at diesel, which is still just not really moving all that much. It started to go up, but now it's been coming back down. Copper is still in an uptrend. And as I say over and over, this is a barometer of the economy. And even though it got hit with everything else, it has been bouncing back up, and the uptrend is still intact for right now. And this suggests that going forward, the copper market thinks the economy is going to be okay. We look at a copper to gold ratio. Gold's been going up. Copper has been rebounding, but not going up as much. And so we're really seeing this ratio coming down. And then we look at a longer term copper to gold ratio and put the 2-year and 10-year yield on here. We can see this ratio has been declining as interest rates have been going back up. Gold set an all-time high in Friday's session. That's considered to be a hedge against insanity, and things have been pretty crazy lately. Silver not doing as well, but still in an uptrend. We look at the closing price for gold on top, and we can see here how silver has been going up too, but it's lagging. It's not setting an all-time high like silver is, but still, when you look at the correlation between gold and silver, it's still pretty strong, meaning they go in the same direction at the same time. Then we look at a gold to silver ratio on top. Gold's been really outperforming, and then the dollar's really been going down, but we're seeing that these two charts are actually going more in opposite directions. Gold has been going up and really outperforming as the dollar has been declining, and that shows the non-correlation that we're getting right now. The dollar's just been getting hit hard. It's underneath both moving averages. We're in danger of seeing a downtrend develop here if the 50 period crosses below the 200 period moving average, and we also dropped below 100. The euro has been pretty strong against the dollar, but not quite setting an uptrend yet. And the Japanese yen is in an uptrend compared to the dollar, but these are just longer term charts that we look at. So the euro really rising up against the dollar, but still not enough to generate an uptrend. The Japanese yen is in an uptrend compared to the dollar. The British pound really close, but not quite there yet with an uptrend compared to the dollar. Then we look at different ratios, and these come in and out of the daily videos. The market's been so crazy lately. I've been kind of dropping the advanced decline line studies and some of the ratios that I show. This just shows how the equal weight version, that's the red line, has been holding up fairly well compared to the S&P weighted index. And we're not seeing a real disconnect here. We do a ratio between the equal weight and the S&P, and this has been chopping around a little bit. If anything, since the beginning of 2025, the equal weight has been outperforming as growth has been underperforming. We look at stocks to commodities, showing how stocks are now underperforming commodities. This shows how commodities are outperforming stocks. The NASDAQ 100, which is pretty much all growth compared to the S&P, which is growth and value. The NASDAQ 100 is underperforming, and we're in a downtrend with this ratio. The S&P 100 is still in a downtrend compared to the S&P. Longer term, it's still in an uptrend, but shorter term here on the daily charts, it's improving, but we're still in a downtrend. These are the large caps against the rest of the S&P 500. The NASDAQ, which is again mostly tech, it's been underperforming the S&P 500. The NASDAQ 100 is holding up better than the NASDAQ. Now, both are not doing very well these days, and the NASDAQ is now in a downtrend. The NASDAQ 100 is not quite there yet, but the bigger stocks have been holding up as we've been going down. That's why we see this ratio going up. We look at mega cap growth compared to the equal weight. We are starting to see a downtrend here, and we've been below this 200-day moving average. That just means the mega caps are underperforming, not usually what you'd see in a positive environment. Small caps doing really bad right now when we compare them to the S&P. The red line, this also shows how we're going down with the small cap to S&P ratio. The blue line is the S&P. Even though it's been under pressure, small caps have been under even more pressure. Mega cap growth, starting to see a death cross here with this ETF. We're well below the 200-day moving average, and we're crossing below with the 50-period moving average. Robotics and AI, not doing very well these days. And the tech sector is actually holding up a little bit better, and the robotics AI ETF is underperforming. Semiconductors are in a downtrend. That's more negative for the market, and we're also dropping further below the rainbow. And we continue to see this rainbow get all jumbled up together here. that could be more negative for the market. It really shows indecisiveness for the semiconductors to go up. That means that they have more of a tendency to go down. This ratio between the semiconductors and tech still continues to fall. It popped up on that big Wednesday that we had, and now it's starting to come back down. The AI and tech ETF still hanging on to an uptrend, but we stay below these lines for a little bit longer, and it's going to develop into a downtrend. And we're starting to see a downtrend here with the Dow Jones Composite Average, which is the Dow, the transports, and the utilities together. That's more negative. And both tech and small caps not doing very well, just chopping along sideways with this ratio. And so we look at the Dow, which really fell but bounced up off of that. The transports bounced up a little bit, but not quite as much. The utilities really just bounced back up into the range that they've been in, where the Dow and the transports have actually been declining more. And we're negative here with our advanced decline line studies, below the moving average with the NYSE common stock, the S&P, the mid caps, and the small caps. And we're starting to see a death cross here with the Wilshire 5000. This is a broad market measure, and we're well below the 200-day moving average. We're not quite there yet with the total US stock ETF. The blue line is not quite crossing below the red line. Low volatility stocks, these are the ones that they don't necessarily go up when the market's going down, but they go down less. And so these are holding up a bit better. They were able to get back above their 200-day moving average, and they're outperforming the S&P with a golden cross with this ratio lately. That just shows a market getting more defensive. The Dow has been really outperforming the transports. The transports now are just kind of getting in to the lower end of the downward range that they've been in, and they're really underperforming the S&P. Now the S&P has been having trouble, but the transports are having even more trouble right now. But the correlation between the S&P and the transports still continues to be fairly strong. Then instead of using traditional Dow theory, we use the S&P instead of the Dow. It shows the weakness here. Instead of using the transports, we use the NASDAQ, also showing some weakness. And this red line here was a previous high that was set, and we're getting down to that area. And we look at the equal weight version of the S&P, which has been showing some weakness, and then an equal weight version of the QQQs, which is the NASDAQ 100, bouncing back, but still down overall. The FANG index below both moving averages could be getting close to a death cross here. These are the big mega cap stocks. ARC still hanging on to an uptrend, but seeing some weakness. All world stocks, which takes out US stocks, this is continuing to be in an uptrend, but we're below the 200-day moving average. And we're bouncing back a little bit here, but we're starting to see a death cross when we do a ratio of US to world stocks. That just means that US stocks are underperforming. And we look at a long-term chart here of stocks to stocks in Europe, Australia, Asia, and the Far East, coming down, but still above this 12, this is a 48-week moving average here. Long-term chart for this one. It's a monthly chart, but the momentum is really coming down. However, we're still barely above zero. We look at bonds where we were really going up based on price. Now we've been really going down. We closed right at the 200-day moving average on Friday. The total bond ETF also fell under its 200-day moving average, but did bounce back up as bonds have been doing better in 2025. We're not quite to an uptrend yet, but the world bond index is starting to improve, and we're below the moving average here with the monthly chart of the stock to bond ratio. And we were coming down. This is a daily chart with yields. Now we're starting to go back up. They're wondering what's going on with that. It could be some selling going on in China because they own 700 to $800 billion of US bonds. It could be a hedge fund in Japan that's run into some trouble. Those are just rumors that are out there. We won't know for some time if they're actually true. This shows international rates with US and UK rates being the highest, then German rates have been coming down, and then Japanese rates did fall, but they bounced back up later in over this last week. And we're starting to see a golden cross here where bonds are now outperforming stocks on the daily chart. High yield bonds, these are junk bonds, they're still holding up okay. They tend to follow the stock market fairly closely. They're trying to get back up to their 200-day moving average. And investment grade bonds, these are higher quality. These are looking a little bit more vulnerable right now. And we're just kind of messing around to see what kind of a trend there might be. Riskier bonds, which are junk bonds compared to more conservative bonds, they had been really falling down, but they did rebound a little bit this past week. And pretty much neutral when we look at the stock to bond correlation chart. The corporate bonds starting to really go down and getting really close here, possibly to a downtrend. We look at the 10-year yield with Fibonacci lines. I show this in every video, but we're really not getting anything from this chart, showing how we're establishing a higher range than what we had been seeing over the last 40 years with the 10-year yield. This also is another fib chart for the 30-year yield, not really getting any insight here. Junk bonds falling down under their 200-day moving average, but trying to get back up to that level. And we do a ratio between junk bonds and conservative bonds. They're taking a bit of a hit here, and we're seeing some possible danger to the uptrend, but it hasn't switched over negative yet. And we look at the volatility of bonds, which have really become volatile lately. Stocks have been really volatile lately. There's a pretty high correlation between bond and stock volatility right now. Then we look at the S&P 500 with short-term bonds coming back up a little bit, but still falling below this rainbow as stocks are underperforming even short-term bonds. Then we look at a broad market measure showing how even stocks on a broad basis are underperforming 1 to 3 year bonds. The broad market is also underperforming 3 to 7 year bonds, and it's underperforming the tech sector. It's coming back up a little bit. It did bounce, but there's been a lot of damage done to this ratio. The S&P is underperforming the 10-year yield. And then we look at how bonds are starting to outperform stocks. We've seen a recent golden cross here. And this is a monthly chart of the 30-year bond where we're still underneath the moving average, which is starting to go back down. And we're rolling over a bit when we look at the bond to commodities ratio longer term. Then we look at the sectors, and these are the material sectors under a lot of pressure lately. Folks are worried about the economy and also underperforming the S&P. Communication holding up a little bit better here, but still underneath their 200-day moving average, but holding up even better on a ratio basis when compared to the S&P. Energy just kind of all over the place right now, but it did not have a good week, and it's back to underperforming when compared to the S&P. Financials showing some improvement, but still underneath their 200-day moving average, but holding up better and in a more solid uptrend when compared to the S&P. And that's good. That's positive for the market. Industrials also more cyclical or economic based, falling down below their 200-day moving average and pretty much going sideways, but hanging on to an uptrend when compared to the S&P. The tech sector, we're starting to see a downtrend here, and that's not good. That's a huge part of growth and a huge part of the market, and also underperforming when we compare it to the S&P 500. Staples, they got hit with everything else, but they are still in an uptrend, and they are outperforming, and we've seen a recent golden cross here when we compare it to the S&P. Real estate, interest rates have been going up, so real estate's been going down. And even though we were showing some real improvement here as interest rates were going down, we're seeing this falling back and underperforming as interest rates have been going back up. Utilities kind of going sideways for the most part, but hanging on to an uptrend and outperforming when compared to the S&P 500. And when this is going down, that means the S&P is underperforming utilities. In a more positive environment, this ratio would be going up. Then we look at healthcare, another defensive area. It even got hit recently with everything else and hanging on above its 200-day moving average, but still in a downtrend that could be improving when we compare it to the S&P. Discretionary, under a lot of pressure now, having trouble getting back up to its 200-day moving average. Still in an uptrend compared to the S&P, but also coming down to its 200-day moving average with the ratio. Semiconductors are in a downtrend, and that's not good for the tech sector, and that's not good for growth. Energy it could be starting to outperform. It was, and we saw a golden cross here, but then energy really pulled back with this ratio this past week. Then we look at growth versus bonds, and that's taking a hit right now as the market's been getting more defensive. The tech sector is underperforming the 10-year yield, and the 10-year yield is outperforming the tech sector. That's just an inverted chart there. Discretionary still hanging on to an uptrend here, but it's really showing some weakness when compared to staples. This shows how staples have been really holding up better. That's a more defensive posture for the market. Gold has been going up as the S&P has been going down. That shows this ratio going up. And the dollar's been going down as gold's been going up. So this ratio is going up here. The NYC composite's hanging on better. We're not as close to a death cross here, but we're well underneath the 200-day moving average. High leverage loans, this is another barometer of the economy, and this is causing some concern. They were hanging on to being pretty positive, and then they started to roll over. They've got back up to their 200-day moving average, but there was some real weakness that came into the market. All stocks, which is US, are US and international stocks together. Mainly it's the US stocks that are pulling things down, but US stocks going down doesn't help world stocks either. Emerging markets, just really choppy. Underneath both their moving averages here, could be getting ready to see a downtrend, but it's hanging on to an uptrend for now. Japan's been under pressure as well, falling further below this red line. And microcaps are now, these are small, real small companies. These are now in a downtrend. And we're seeing a little bit of a disconnect here between the S&P and the home builders ETF, but it's back to neutral, where they tend to have a pretty strong correlated relationship. When they go in opposite directions, that's where we really take notice. And this kept falling, 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 but now it's reversed a little bit. So maybe it's going to get back and be a little more normal. Bitcoin has now seen a death cross. It just cannot seem to stay above 100. There's a lot of speculation out there that because of the ETFs and institutions that can now invest in Bitcoin, that was supposed to send it to $200,000. Well, what it's done, it's kind of stalled things right now. And so it's been pulling back. And there's a pretty high correlation between Bitcoin and the NASDAQ 100. And both have been under pressure lately. And we look internationally. China's in a downtrend, as are emerging markets. Downtrends in Europe, Japan, and now we're more in a downtrend in the US. With the intermarket analysis chart, gold is still performing best year to date. Bonds are back to break even based on price. Then we have the dollar, which is negative. Then stocks, which are not in last place right now. Oil is. That's the red line. And correlations coming down to being more neutral when we look at the S&P to the dollar index. The S&P to oil, pretty strong correlated relationship. They both have been going down for the most part. And then the S&P to the 10-year yield, neutral, right about at the midpoint now. Tech sector to the 10-year yield, also neutral. And the S&P to the 2-year yield, it had been a pretty strong correlated relationship. Now that's starting to taper off. Some long-term trends. This is a monthly chart of the NYSE. We're falling below the 12-month moving average here. That's turning it more negative. Now, the NYSE has been holding up better, but it's still seeing weakness itself. And the Copic curve, which is a momentum oscillator, is also starting to go down. This is a daily chart where we use the NYSE record high percent index. When this is going up, that's positive. Lately, it's been coming down. And we look at a monthly chart of the S&P starting to drop below its 12-month moving average. And we're seeing the momentum longer term show some weakness as well. Then we look at another monthly chart of the S&P dropping below the 12-month moving average, and then a longer term relationship between stocks and commodities. And this had been showing stocks outperforming. Now we're starting to see commodities outperform. And then another global chart here. We're still holding out above the moving average, but the KST, which is a long-term momentum oscillator, it's showing some weakness, but it's still above its moving average. Then I go through and list all the things that are still positive for right now. And there could be more changes if we see more weakness. We have growth and value by themselves are positive. Copper's in an uptrend, as is the dollar for right now, but it could be getting close. The yen to the dollar, that's a new addition to the list. The CRB index is in an uptrend. Gold and silver are in uptrends. The FANG index, but that could be getting close, as is ARK. And the low volatility ETF by itself has been holding up. Staples are in an uptrend. Bonds, when you look at the total bond ETF, the high yield bonds, investment grade bonds, and junk bonds, But there's this weird stuff going on that's really hurting bond prices right now. The tech sector, that should actually be on the negative side. That's in a downtrend now. High leverage loans, another barometer of the economy, it's showing some weakness, but trying to get back to its 200-day moving average. The Dow is still in an uptrend. The NYSE is in an uptrend. The NASDAQ 100 is still in an uptrend. All stocks, both US and international stocks, are in uptrends. Emerging markets for right now. Then on the negative side, have a few additions here. Mega caps, and that's not positive for the market. That's the real growth area of the market. And if they're doing weaker, then that's negative. The euro and the British pound to the US dollar, although they could be getting really close to generating a golden cross, they're still in downtrends. Semiconductors, which includes the SOX index and different semi indexes that we look at, as well as ETFs, they're all negative. The World Bond Index is still negative. Corporate bonds, looking a little better there. And then we look at the NASDAQ, which just generated a death cross this past week. The mid caps, small caps, and micro caps are in downtrends. The Wilshire 5000, and there's no L in there, but that's in a downtrend now, a broad market measure. And Bitcoin is another new addition to the list. Thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.